So the rising cost of living is affecting everybody, with seniors being one of the most affected groups in Canada. The poverty rate among seniors has been steadily climbing with significant increase since 2021. A lot of seniors are now relying on debt, help from family, or just going without because of this. One of the biggest challenges that they have is a change in their health. A lot of seniors are restricted to a certain part of their home simply because they can't access the stairs or some of the other parts of the property. In a lot of cases, they rely on friends and family just to meet their basic needs. Some of these challenges leave seniors and their loved ones in a very difficult position. They ask themselves, should we sell the house and downsize to a condo, or maybe even look at going into a nursing home or retirement home? The fact is, most seniors want to stay in their home. They want to stay in the home where most of their memories are held and where their surroundings are familiar. Thankfully, there is a solution out there. With the increase in the home prices that we've seen, seniors are sitting on a considerable amount of equity, and this equity allows them to access what's called a reverse mortgage. A reverse mortgage is a type of mortgage product which allows you to withdraw money from your home, your equity, as a lump sum, monthly, or a combination of the two. The nice part about it is that these withdrawals are tax-free. Because it isn't income, it's technically debt, and so you aren't taxed on it. You may use this money as you please, but here are a few ways that seniors are accessing this equity. Renovations to improve accessibility. Maybe you want to get a stair lift, a more senior-friendly washroom, in-home care. You can use this funds to hire a personal support worker or other professional to come help you with your day-to-day tasks and your basic requirements. This allows you to stay in your home while maintaining a good quality of life for you and for your loved ones. You can use these funds to pay off an existing mortgage or debt. So you don't have to own the home free and clear to get a reverse mortgage. You can simply say, you know what? I have a lot of equity in my home. I do have a little mortgage and some debt. I'm going to use a reverse mortgage to pay that off, and I just won't have bills for the rest of the forever. My income that I'm receiving now is more than enough if I remove those monthly bills. So you can use your reverse mortgage to do just that. You can help family. Look, you've helped them enough. You've put them through university, maybe paid for their wedding, paid for a down payment, paid for the legal fees on their divorce, maybe even bailed out a grandchild. But if you want to continue to help them, you can. But I think it's time that they help you. Lastly, just enjoy your retirement. Take the money component out of, or the money worry out of your life and, enjoy your retirement without having to worry about how you're going to pay the next bill. Some of the key requirements. So it's only for owner-occupied homes. You can't put it on the cottage. You have to be living in the home. You have to be at least 55 years old, living in a larger urban center. So you don't have to be in Toronto, but a larger urban center. You can't be completely rural. And the beauty of it is little to no income is required to qualify. So ratios are very flexible simply because there are no mortgage payments that are being withdrawn. In fact, in most cases, you're getting a monthly deposit. Very little is required to qualify for this mortgage. And the same goes for credit. You don't need to have perfect credit to access a reverse mortgage because they're not relying on you to pay mortgage payments. Now, what are the frequently asked questions and myths about reverse mortgages? Can I get a reverse mortgage with bad credit? Yes, you can. Can the lender sell or foreclose on my home? As long as you meet your financial obligations to the lender, you should not have to worry about the lender selling or foreclosing on your home. Can I get out of my reverse mortgage? Yes, you can. And in fact, the prepayment or repayment terms are quite flexible. When is the mortgage due? So the mortgage is due with the sale or transfer of the property, when the oldest homeowner moves to a long-term retirement or nursing home, or when the last borrower passes away. What happens if my spouse dies? If both spouses are registered as joint tenants on the property, then the surviving spouse can still live in the property and use all of the benefits and advantages of the reverse mortgage. It works the same exact way. Here is an example of how a reverse mortgage works. Let's do the math. Okay, so let's put in some basic calculations just so you get a better understanding of how this works. So let's say the youngest person that's living in this home is 75 years old. All right, they live in Ontario and they are in Ottawa. Okay, and let's say their home is worth $800,000. Okay, based on these statistics, or numbers rather, the maximum equity that they can take out is $408,000 on the Flex Plus. but that comes at higher pricing than the flex, and it's more than they need. So but it is available there. So all they need is really 384,000. So we're going to select the flex. Now keep in mind, these rates are just for information purposes. Often this lender will have promotions where you're going to get a lower rate than what is being shown here. This is just for, again, for information purposes. So we're going to select flex. Now, you can choose whether you want all the money at once that you're entitled to, so you can take that money and just do with it as you please, or if you want it spread out over time. So in this example, we're going to use the spread out over time example, but again, you can play around with that. So let's say, how much would you like to receive as the initial advance? So this is the amount that gets paid right on closing. So often people will want to take out some money to pay off debt or do a few things with it, and then the rest just receive it monthly. So in this case, let's say they want $50,000 to pay off some debt, maybe retrofit their home to make it more accessible. So that's costs, let's say $50,000. So now we've got $50,000 there. And how much would they like to receive per month? So they figure, in this example, maybe $1,500 a month is going to be enough to give them that quality of life that they're looking for. Maybe it'll allow them to travel, help family, or just participate in more activities. So let's say $1,500 a month. And keep in mind, this is tax-free because it is technically debt. It's not income, so it is tax-free. And then how much they would like to have it for, let's say, 15 years. All right, so let's see how this is broken down. Okay, now keep in mind with reverse mortgages, you don't have to receive money every month, but essentially what's happening is you're not being billed a mortgage payment. What happens is that mortgage payment that you would have been paying is added to the total amount that you owe, and that's how it works. So nothing is being withdrawn monthly, it's just being added to what is owing on the house, and that's why you don't have any payments. Now, you can prepay, you can pay off the interest every single month. There are prepayment options, but for this example, we're just going to put, assuming somebody is not paying back anything, they're just receiving a supplementary income. With a home value of $800,000, living in Ottawa at the age of 75, the maximum they can receive is $408,000. But in this example, we're not going that high. So they went with the reverse mortgage flex. So the initial advance is $50,000, as we discussed, and monthly they're going to be receiving $1,500. So they'll be receiving $1,500 per month, okay, and they want it for 15 years. So you can take a look here. So year one, you got that $50,000 advance, and you receive $1,500 a month. So you can see how every single year the balance is increasing, right? So the initial was 50,000. After 1 year, they owe 71,000. After the second year, they owe 95,000. Third year, 121,000, and so on. And you can see it continue to go up and up. Now, if you look at year 15, okay, they owe 655,000, and now you're thinking, well, how's that possible? Because that's higher than what they were allowed to withdraw in the beginning. The reason that works is that the lender factors in increases into the home, and so that way they have access to that equity. And so they give you 3 examples here. So one is if the home increases at 5% a year, one is if it increases at 3% a year, and one is an example if it increases at 1% a year. So if you're worried about, am I going to still leave equity to my kids? The answer is very likely that you will. Why? Because, well, if the home appreciates even 1%, there's still going to be equity left for the children or for the estate. So if you look at here, let's even look at a 1%. So let's be very conservative here. But after 15 years, assuming the home increases at about 1%, that home is going to be worth in 15 years $928,000, okay? But they're going to have a balance of $655,000. So there's still about $273,000 in equity. So this entire time, they've been receiving $1,500 per month, tax-free. They've been able to have an excellent quality of life, and they're still leaving a considerable amount of money to the estate. Now, of course, if these numbers change, then that changes. So if the home increases by 3% a year, then you can see
that, there will be about $591,000 of equity left after 15 years. And if it's, it goes up 5% a year, well, there's going to be $1 million left. And these are all for information purposes. But, the key here is that, yes, you're still leaving something for your estate, but you're still not sacrificing your quality of life just to be able to do that. And so, this calculator allows you to do many different things. This is just one example of it, but it's a very good program for those who are in this position and who may be able to benefit from this. Again, these rates are on the higher end. Like, I've seen rates in the fours, in the fives for these types of clients. So these are just examples, but definitely a mortgage worth looking into for those that might be a benefit to.